Good turnaround Tuesday, everybody. Alexander, Brand, DJ, how are you? Sinatra, Mike Bergman, the whole crew, the whole army is here today. How you doing, team?
How you doing, mate?
Morning.
Yeah, everyone doing okay? For
Good morning. Dale?
What's that?
You ready for 6% interest rates?
Maybe down the road. I don't think right away.
Well, Bank of America are calling for them.
Are they? Okay.
Yeah.
For what? The 10-year?
For Fed rates.
Oh,
Which
okay.
part of Bank of America? Do you know?
The rubbish part, probably.
Because I remember I used to work there.
It's just the research. It's the research mob.
Okay. I'm not going to comment.
Okay. All I know is this looks stretched to me, and I was going to short the yen up here. Did you do it? It got to near our numbers up here, a little reversal taking place.
So 137, 136.90s. Didn't quite get there.
When's the ISM? Because if we get a decent ISM number, maybe they'll pop the 10-year. I'd like to see 4% print. That would cause, maybe a little bit of panic and exuberance for, what we're hearing now, like Bank of America. And, that may be the day to try it.
Could get it today. US consumer confidence.
Okay. So be on alert for that. I'd like to see just one more marginal high in the 10-year, take out stops above this high, and this was 390, call it 398. So it wouldn't take much, 5 bips, 6 bips, 7 bips. Gold, I noticed I had to go, to the 15-minute, but it got very close to that 1803 level. Where were we earlier in the day? That's 15 seconds for crying out loud. Okay.
That's a good time frame.
I think
you should keep the chart on there and keep this show really lively.
I'm scalping, man. 15-second candles. I'd have to be 21 to trade that. All right. Anyway, so got down here. And I think there's a fib about 1803. I'd like to see him try it one more time down there, and I'm going to buy it because we did confirm down here. If we do it again, I don't think we will. And silver got pretty close to the fib, so got, I think 2020 is the fib. So I'm getting ready to start buying. I'm not going to I'm going to do what I say and not go all in, but I'm looking to have some exposure. If that happens, I'll probably just buy the miners. Someone sent me a chart today. I think he's, one of our crews, and GT New, I think he's he's been part of this family, I think, for a long time. He's showing Newmont here. Pretty, at some fib levels. I think we're at 61.8 as well, or 78.6. Anyway, looks broken, but they always look the worst at the bottom. What are you guys thinking for a turnaround Tuesday?
I'm thinking yields are still going higher.
Okay.
That's what's driving everything. I've been saying this for weeks. I know I'm really boring, but yields are going higher. I think the 10-year is going to challenge 433, those highs. The question is what happens after then, sorry. But until that happens, and as long as data doesn't turn completely in the next weeks, I think the yields keep going higher. For the stocks, yes, they're rallying a little bit today, but they had a down day yesterday. I think the path of least resistance, not the path of least resistance, sorry, the logical move would be to see stocks going down. The question always remains about positioning and sentiment and everything, but I see the big picture, and this is still the big picture for me.
Okay, so 435 is good kind of key. What's going to thrive in that environment? Is it a short everything type of market because of rates heading up there? what thrives in that kind of environment? What asset class appreciates in that type of environment? I
The
can't
dollar.
think of one.
The dollar.
Okay. Oh yeah, there you go. Okay.
Yeah, but
So the dollar.
yeah, it's all one trade, unfortunately,
The
more or
dollar.
less over the yeah. Or no, it's yields for me. It's one trade, and
Okay.
it's more or less. Obviously, you get you know what I mean. But
Chicken or the egg? Yeah, the dollar or
chicken or the egg?
yields.
Yeah,
Yeah.
yeah.
Yeah. Okay. All right. K-Man feeling better? Is he back?
Yeah,
I didn't check.
I'm back. I'm not 100%, but it's all right. Good enough to be in the community.
Okay. So any take on the strength we've had in cable in the last few days?
Yeah, I mean, yesterday I was looking at it and I was a bit too conservative, and I think there was a bit of a case for being long sterling for a while, and it's materializing now. We don't know how much of this is end of month stuff.
Okay. Yeah,
because
good point.
sterling has been bid on every hour in our morning. Or how much is in the mix this deal that the UK struck with the EU. Could be a little bit of both. Some may be forced to trade it. But yeah, I'm a little more constructive on sterling than I was for months. So
Okay.
I'm also looking at the yields there, and they are picking up even faster than the UK even faster than the US right now. So that is likely explaining a bit of the sterling strength as
They
well.
have a higher inflation as well.
You have a higher inflation, but the move came in the past couple of sessions. That's what I mean. Since and actually since February started really, we've done a lot on the UK yields. Of course, there's a lot of inflation in there, but if you look at, I'm looking at the differentials as well, and they're a little bit more in favor of the sterling right now.
Okay. I just want to point out, since you brought up month end, it's a great point to think of, because I'm looking for some turns, right? So if I'm looking for some turns, I have to think that they're not going to happen until next month. I mean, we're not going to reverse these negative candles. There's gold monthly.
Yeah.
Here's S&P monthly. It's still negative. You have a lot of negative candles.
Yeah.
Bad one
Yeah,
in Aussie. So you probably have to wait for early next month
Well,
for some type of turn in a lot of these markets. I mean, that's what I'm thinking, that I shouldn't get FOMO, because on a monthly basis, all this stuff is closing like hell. And if you're going to get a turn to reverse it, you start a new month, just like you start a new week or new
yeah,
day
exactly. I
for a
mean,
reversal.
exactly, Dale. You look at how it closes today and how it reopens tomorrow, and then but yeah, I mean, for stuff like, for instance, cable, we might be a little late already, because we were trading 119s yesterday or the day before, right? And
I know, it's amazing.
trading 121. Yeah, so we have to, but when moves start, when reversals start, it can be something to do with the calendar, like end of month, but it's not going to stop after 150 points if they really have to reverse, right? I mean, that's what I mean. If we really have to me, I think it's still too early to call for big reversals in the dollar, but as I was saying earlier as well, or end of last week, we're getting to interesting levels. The euro dollar, if we would get a print under 105, cable is not holding under 120, but to me the big zone is still this 117 and a half, 118. Holds that, then it can force
one more low
springboards for going to see higher levels. I'm still not, as I say, I'm still convinced that the dollar is going to weaken from here, but it's not because something it doesn't weaken that we can't be in a bigger range, and you try to find the edges of the ranges, right?
Yeah. Okay. Copper is really, interesting. So I thought we had a breakdown. Now it doesn't look like that. Now it looks more like an ABC. So, copper I thought this was going to give us a negative economic signal. Now it's doing the same thing here. Don't trust any breakouts or failures in copper, that's for sure. Yeah, I think that maybe we need to talk a little bit about risk here. S&P's had some problems yesterday and sold off from 40.20. I could see either a rally to 40.40, or I still think this is a battleground down here. Around now, it's coming in around 39.10. So we'll see. So far, Friday's low is looking pretty good if you bought it. Underneath it, I think it's a big battleground. So I don't have. I guess the thing that's closest on my radar is looking for long entries in precious metals. I still think that the dollar has one more shot up above this high, and euro I still think can trade back down to where K-Man's talking about it, and we'll see about the yen up here at 137.
The big
WTI,
zone, big
yeah.
zone, and can even stretch it up to 138 really in the dollar yen. It's a big zone, very big zone.
WTI looking good. Put in a higher low here. Probably going to test the top of the range. That's usually not too bearish for the market if the oils kick in, because you know they've been leading for a year or so. So not a bad looking oil chart. I think at least for a move up to here, and then we'll see. And I think that's pretty much. Oh, one more thing to look at. You know, the platinum's been pretty wild. Okay. We had this nice little rally that looked like a bottom, and then we had a stop hunt, and now we're right back at resistance. So platinum looking better than silver, right? Platinum looking better than gold, right? So if you're a precious metal bull, here's your leader. And I rest my case. So the defense can now present their case here, and lead attorney is Blake Morrow. And Blake, the jury
Judge
is waiting
Judy.
to hear. They're waiting to hear from you today.
Good morning, guys. How's everybody doing?
All right.
Good morning.
Hey, and hey, you know, before I even get started, I wanted to say, K-Man, it's nice to have you back. I see that Grega's in the house. Really nice to have you here, Grega. I want to look for a view on an Elliott wave view for everybody here in a few minutes. So get your you guys get out your
Cameras.
Yeah, exactly. Get ready to screen capture some stuff.
Yeah.
And Stelios, I would say it's nice to have you back, but you know, it's really not.
But
So,
no, really, yeah, I know.
you know, and I was actually just tweeting something about the euro sterling, and I'll just kind of
Go ahead, buddy.
show you guys what I was talking about really quick.
Sure broke that bear flag like you were talking about yesterday.
Yeah. So we got the bear flag going through. The problem that I see right now, it's a few fold, because we were talking about the sterling strength across the board, right? It was not just a euro sterling story. You could go to the pound New Zealand. We were breaking out. You know, this is a previous neckline of the old head and shoulder pattern from way back last fall. You got the pound Aussie, which is also, you know, rallied out of the channel. We were attacking the 618 yesterday, and I knew that this was going to give us a little bit of a problem, but it ended up being like just a bit of a speed bump as far as I can tell. But one of the big issues that we have right now is the pound dollar, and we're up against you know, what you would figure is A, it's wedge resistance, but B, it's at a 38% retracement. So you know, if it's going to stop here, technically I'd understand why. That doesn't mean it's going to stop, because as Ryan and K-Man have pointed out, and they've been talking about the last couple of days, there's a lot surrounding the market from a Brexit standpoint, which Ryan, I'll let you expand on in just a little bit. But I think that if you're trading the sterling, you just have to be, excuse me, a little bit more careful at this point. And this is the one thing that really kind of bugs me about the euro sterling move, other than the fact that I'm not short it right now, which I feel like I should be, but I'm not. one of the things that's bugging me a little bit is this divergent relative strength as we hit new lows. So you can see we hit new price lows, but relative strength isn't. So that's a pretty big warning. And when you take, the euro sterling is one of the most liquid pairs that you're going to find in FX. That does worry me a bit. So Ryan, what kind of headlines have we got with the with Brexit right now? And I know Brexit, people think it's not a thing, but it actually is still a thing now, right?
Yeah, this is the Northern Ireland stuff, and a deal was announced yesterday. And when the headlines hit that a deal was done, cable dropped 5 pips. That was the reaction. We've been trading this for months. I'm differing to K-Man. I don't think much of this power move is to do with the Brexit stuff. I think it's purely the volatility that we often see more in cable than we do in euro dollar. Euro dollar's got what, 45 pip range. Cable's got a 90 pip range today.
Yep.
I say it often, cable, if euro dollar moves 30 pips, cable's moving 50 pips. There's always a volatility difference in that. Euro sterling I'm not worried about. I'm still long below, long at 88. I'm going to be looking towards the low 87s for a bit of an add and a short-term play against the prior low that we had down there, 87.20ish. I think it got down to. This is euro sterling. What it does, it does nothing for days and weeks, and then it has a move, and then it stops, and then it has another move, and I don't see any fundamental change at the moment to see euro sterling completely drop down unless the pound goes on a huge rally.
Okay. All right. Well, thanks. I appreciate your feedback regarding that. Now, one of the things I wanted to, before I pass it over to Grega, because I'd love to get Grega's Elliott wave views on the markets here. I don't know if you guys talked about it yet, but we had some inflation data come out of Europe and the Eurozone today, this morning, right? So we had the Spanish flash CPI came in hotter than expected. That was a mover last time we got. Well, not last time. A couple months ago, we had that's one of the things that kicked off like this euro squeeze, if I remember correctly, back a few months ago, was right through here, and it was Spanish CPI. It did come in hotter than expected overnight, but we haven't seen the market really move. French CPI came in month over month a little bit less than expected, or a little bit worse than expected. What do you guys make out of this inflation data? And does it just reaffirm that we have a global inflationary problem? What do you guys think?
Was that in doubt? That we have a global...
I don't know if it was ever in doubt, but it hasn't moved the euro, and I was surprised to see the euro not move. That's when I got up this morning. I was like, huh, all right, the euro's still plugging away at the we marked up that resistance yesterday at 106.20 on the resistance on the euro dollar, and it's still stalling there. So
seems that the market is currently focused tunnel vision on the Fed, and they seem to have more trust that the Fed will be more aggressive in handling inflation than the ECB. And just between us, don't let that leak. I agree with that point of view, meaning I have even less trust in the ECB than I do in the Fed.
Hold on, let me tweet that out. I'll be back.
You have, wait a second. What you got? What you? I thought you were a Christine Lagarde lover. So,
oh yeah, absolutely. I love Christine.
The thing is the euro. I just want to say it's probably, and this is one of the, the analysis piece that I sent out this morning regarding the euro, because if you go over here to the updates, you can see like the different updates, and I was just updating all these charts this morning, and one of the things I noted is we're seeing a bounce in risk. We've seen about I think the markets have recovered quite nicely since also from the overnight inflation data that you saw in Europe. I say overnight, but the early stuff for you guys in Europe. The markets have already recovered, but the euro is just not moving, and we're seeing a very lackluster, well, no follow through yet. We do have an inverted head and shoulder pattern. If you guys can't see it, I'll just identify it for you. You have a little inverted head and shoulder pattern that could lead us to a bit of a breakout today. So I don't want to
and
give
Blake,
up.
coincidentally or not,
Steve, hold on one second. I don't want to give up on the euro bullishness yet, because this breakout could lead to this move right here to the 38% retracement is the neck to head move. So it could still make it to 107.20. It's just, it hasn't done it yet, and that does concern me a little bit. Okay, Steve, what were you going to say?
Now overlay the S&P 500 to this chart.
Okay, here you go. It is coming. Wait, what happened to my? I just had it there somewhere, but I guess it disappeared. Hold on, let me put that back on. Yeah, let me put it.
Yeah,
up there.
so weaker dollar is keeping the market up. Is that your point, Steve?
We have a very
It's
similar.
moving. Yeah,
we have a very similar pattern in the short term in the S&P as well. The S&P might, of course, it's too early to say that, and a lot of people jump the gun and confuse forming triangles with potential inverted head and shoulder formations or head and shoulders formations. But the same type of formation we can see in the S&P as well.
Yeah, there is a little inverted head and shoulder pattern. You can see it kind of developing here.
it looks weaker.
I've been hoping for, and if you listen to the daily morning edge that we do here in about an hour with the ForexAnalytix crew, I've really been hoping for a move up towards the 40-50 level. I want to sell risk on a bounce up here.
Yeah.
But it's like the longer we don't get it, the more worried I get, because you get to a situation, Dale, where you get FOMO. Now, FOMO works a couple of different ways. From a trader standpoint, FOMO works as in, this person is buying or selling this, and I want to be part of it. But in the markets, FOMO can also work from a risk management standpoint. Like, I really was hoping for the stock market to bounce so I could sell off some big positions in my portfolio, and it's not happening. Holy crap, I'm gonna have to turn around and hit the bid, right? I'm gonna use a Chris Weston term, because I think he called it FOMI or FUMI, or fear of underperforming massively, which is a portfolio manager risk, right? And so that is if the S&P doesn't bounce soon, you're going to get people just hitting the bid, because they're going to be like, shit, I don't want to be part of this market anymore.
They still want that red line, man.
But yeah, I mean, well, that's
underneath
a 200 period moving average. Yeah, I mean, the 38% retracements right here. I mean, that's what everybody's hoping for. I hope we get a rally up there so we can sell into it. But if you're not going to get it, then you're going to eventually get people that hit the bid. And you're going to get the same thing with the euro, because we've had the same issue with the euro last week. We were selling off, and the thing that we noted is, hey, these bounces are very shallow. We couldn't even hit a 38% retracement on the previous bounce. And now here we are again, we're having a hard time getting in even to the 24% retracement. The longer it takes us to bounce, the more risk it is to the downside. But anyway, I just want to make that point. But I don't want to take all the time away from
Blake. I have a
Grega.
question from last week. You piqued my curiosity. I'm sure that our attendees may not understand it either, but you were showing the South African rand, and that if it got through a certain point, it was going to mean there was going to be some messy financial conditions out there. Can you explain why?
Well, emerging market currencies, K-Man, he's really good at this, because him and Kay and I, and in the chat room, it seems like we trade a lot of pesos and a lot of rand. Yeah. He was bringing to light a lot of the political issues in South Africa. But as far as an emerging market currency goes, when you have the emerging market rates that are as high as they are, like you take Mexico, they're at 10%. I'll have to go double check where South Africa is at, but it's very high. You can actually get a carry by buying, commodity or emerging market currencies over even dollars. But those trades reverse when you see risk aversion, and then the risk is that people start dumping those carry positions in the market, and you start getting, this cup and handle starts playing out towards the upside. So I'm watching very carefully.
Looks
you can
like
see I
it
have
will.
alarms set up there. So
yeah,
what's that?
Okay, looks
Yeah,
like it could go up there.
Yeah, it's a big big potential setup that if we start breaking out, I'm going to be going long. I don't even care what the interest is going to be carrying it myself personally, but it should probably squeeze pretty aggressively.
Great education, Blake. Thank you.
Well, thank you. And, Dale, I was thinking about this yesterday. I learned something new from you pretty much every day. So thanks for being here. Let's go to Grega. Grega, what are you looking at right now? And I want to give you the charts because we want to see your views. You can see them on ForexAnalytix. You can go over to Elliott Waves and you can, pull up his charts here. But I want to see your updated charts, like to the second. So what do you got for us?
To the second.
To the millisecond, Grega.
Yeah, I was trading a 15-second chart today, Grega.
I hope you do.
My broker likes me.
I hope you do Elliott wave analysis on 15-second charts, Grega, right?
Yeah, I barely do them on 15 minutes, so don't expect them. Okay, so last time when I was in webinar, we talked about this ABC flat formation. So I still think that wave B or wave 2 can pull back to 3,800. At the same time, I think that the VIX still has a room to recover towards the upper side of this 2022 range. So definitely, I'm looking for higher stocks this year, but I just think that we're still in the middle of corrective phase. And whenever VIX will move towards the upper side of the range, that's when I think that stocks could have the most potential for a new bounce higher. So for now, I still think that maybe dollar rally is not finished yet. And before we go to some of the dollar charts, also crude oil still stuck in this triangle. I just cannot call this to be low simply because I cannot count 5 waves up. So normally when you have such a strong drop and then just sideways price action, normally that represents a correction. So I think that for this year, pivot could be around $62. That also goes back to 2021 swing lows. So this somehow also suggests that maybe dollar could see some more upside. Looking at dollar yen, well, here dollar yen, I think we could be in the right shoulder of the head and shoulders formation, and potentially, as you can see there, we are already moving into this resistance. The first one was measurement of a left shoulder, so that was around 36. But even more important, in my opinion, would be these levels from 38. It was in the mid of December. And why I'm looking at this level is because if you look, I'm looking here on a futures contract on Japanese yen, and you can see a massive gap here on December 15th. Obviously, it was a new contract, but when there are rollovers, obviously there are position adjustments, and that's why I'm looking at this to be as an important level. So that comes in around this Friday on December 16th, and this is the same level. If we go back to dollar yen here around 138, as I said. So that's, in my opinion, could be quite interesting potential stopping point for this rally, especially if we consider also the Elliott wave structure and this head and shoulders potential formation. If we look at some FIPS here, we are currently at the 38.2%. But all of them, 60 and 50, this is the major resistance definitely for the current recovery. With that in mind, of course, dollar index, same situation now is at the first resistance, but because of stocks, which in my opinion, at least in the US, they are looking somehow in the risk off mode. German DAX, for example, is completely different. We have seen a very nice, strong bounce in the last 2 days. So maybe even we will see a new high of the year there. But as we know, dollar is somehow more linked to the US markets, US stock markets. So here, I think that 105.80 is the first resistance. Then watch out for 107. So that whole area is pretty close. But in my opinion, we do not have enough of data to say that we are already completing this rally. Of course, in the next few weeks, I think that potentially we will see this reversal happening. Also, if we look in Aussie, earlier you mentioned pound that is very strong. I'm afraid that this pound is actually, it's on the rise on its own. It's not confirmed by the other currencies. So if dollar will suddenly see more strength during the US hours, I think that cable could pretty quickly turn back to the downside. And if we look at some, for example, here on Aussie as well, we are just consolidating, still think that we are in this correction. You have a wave 4 support looking at 66.30, but big picture, in my opinion, still very important. We are just in a corrective phase, I believe.
Right.
So
beautiful.
Even here, we are moving into this interesting zone that could play important role in the next few weeks. Also, earlier you mentioned copper. Just it's not easy to apply the wave count at this moment here. Maybe you are in some kind of a very big triangle, but from a basic technical perspective, this could be potential left shoulder, head, right shoulder. So even this one could find some buyers here in the next few weeks. If suddenly, let's say that dollar will sold off significantly and that we'll see these reversals earlier than I think, then my focus will be on Kiwi. Kiwi is already trading in this very interesting support zone. For now, we do not have this any kind of a 5-wave rise from the lows that will confirm that we are completing this drop. But if this would happen and we see 62.60 broken, then I think buying pullbacks could make sense here, because then this break below these January levels would be seen as a temporary end failure. So that's definitely my first one on the watch list if potentially we go to risk on flows much earlier.
Boy, you covered a massive amount of ground and a lot of great, scenarios and narratives in there. Thanks so much, Grega. Beautiful.
Yeah, thank you. Thank you, Dale. Enjoy your interview.
Boy, was that power packed, huh? And I have my trading warrior brother, Luke Gromen, here today. Luke, how are you, my friend?
I'm doing great, Dale. How are you today?
Good. Great to have you here. I mean, we have a lot of things going on, and I'd like to start with, I was going through your stream. I prep before I talk to people, and I don't think we've ever covered Bitcoin and what your view is, but you've done a few interviews and it looked like Bitcoin was one of the major topics. What's your view on Bitcoin? Are you a believer in it? And how did I miss that?
I am not a crypto guy. I am a Bitcoin guy. I look at Bitcoin very simply. I think it's really interesting that the SEC has called Bitcoin a commodity. It's the only one that is not a security. It's a commodity because, in my view, Bitcoin is simply a neutral reserve asset.
Okay.
With an energy tied to it. The proof of work algorithm where you have to expend energy to receive the Bitcoin reward, means it is tied to energy. And so I think it very much resembles a digital gold in that way. It's not used for anything other than, in my view, a store of value for people, a store of value with extraordinarily high volatility that you need to have your position scaled appropriately given that. But that's how I think about Bitcoin.
Okay, I mean, you can't beat its portability, can you? I mean,
no.
In World War II, people stuffed diamonds in their socks or whatever to get across borders to escape whoever their enemies were. And it's certainly hard to carry a silver coin bag pre-65 silver coins. You could get a hernia doing that. So as someone told me, all you have to do is really memorize about 13 words. And you can be anywhere in the planet and access your wealth. What else can you do that with?
It's so powerful, and that's not my base case, but I do think it's very important that there is no other asset where, like you said, if worst comes to worst, all you take is the shirt on your back, you memorize your passphrase, you go somewhere else, you eventually start working again in some capacity. You save up enough money to buy a phone, you download your app, you put in your password, and boom, there's all the money that you work your whole life for, right there, stored still. And then you start over. And so it's not something Americans spend a lot of time thinking about, but you go pretty much anywhere else in the world with sort of either more recently, or you talk to older people in other parts in the world, and they understand implicitly the power of that.
Yes, I mean, and we even talk about it. We talk about being in the right asset classes, right? And to being diversified in asset classes, but most of us have no political diversity.
Yeah.
Okay, should things change, and as they are changing, and people that have come from other countries that have had to deal with authoritarianism and freedoms and speech being taken away, and things that people say are coming to America, don't understand that you also, besides your assets being diversified, you need political diversity. Do you ever think about that? Because I know, you're here. Do you ever think about maybe I need to do that to protect myself and my family, is have some political diversity?
I have thought about it. It strikes me from time to time. The way I think about it is there are sort of finite, hard signals in my mind that if I saw them occur here, would sort of be like a trigger switch to saying, okay, something has changed. Now, I need to do X, Y, or Z. For the most part,
you're going to ride it out here.
I think it's the best place to be. I think it's the best place to be.
That's encouraging. That's encouraging that this is going to be the best place to be when we get to your end game. And, I want to ask you, Luke, and this has been a pretty severe correction, and I don't really call it as dollar related, but who's selling the gold to take it down from 1960 to 1800 here? Any idea?
I don't know. I really don't know. I think it's probably sort of the financial traders who have gotten, hey, hotter inflation, Fed's going to 6, Fed's going to, 5.5, 6. And that's sort of the reaction I think we're watching. I think it's very short-sighted in nature. I understand why it's being done, because what the higher for longer or the big flip or whatever, okay, I get it. That's the financialized trade. That's the short-term trade. You sell gold. What the big flip, higher for longer, that's sort of step one. Step two that they have not gotten to, in my view, in terms of the perception, is the oh my God phase of what 6% Fed funds actually does to the US fiscal situation. And the last thing you want to be doing is selling gold at 6% Fed funds, because you're now talking about $1.8 trillion pro forma in interest expense, another $3 trillion in entitlements. So that's $4.8 trillion. All-time record tax receipts were $4.85 trillion last year. You needed 8% CPI to drive that. You needed an everything bubble to drive that. Both of those things aren't the case anymore. So your tax receipts are already falling. They're down 7% on individual tax receipts year to date, and fiscal year to date. January was down 9%. They're going to get worse because there's going to be a lot less in capital gains coming. California, for example, was down 42% year over year in January in tax receipts.
Wow.
So,
so we have the crunch is here. We're now entering the end game, because what really kept it going, besides the Fed and Congress with fiscal stimulus, was tax receipts while the economy was doing okay. And now it's not happening, so they're squeezed. You put it as a binary situation. The Fed has to make the decision to either let the dollar go or default on its debt, that there's really only are two choices. Can there be a muddling of doing both and rotating them from time to time, so nothing happens all at once, but they try and stretch it out? And don't you think when it comes down to it, they're going to make the dollar the sacrificial lamb rather than default on the debt?
Absolutely. The dollar will, in the end, be thrown under the bus. Can they string it along and muddle along? They've done an admirable job so far of some version of that. The challenge, and this is the downside of leverage, right? This is, 40 years of Reagan proved deficits don't matter. Reagan proved that debt doesn't matter. Well, yeah, for 40 years, that's right. And then all of a sudden it does. And so when you have 125% debt to GDP, when you have deficits at the absolute peak of the economic cycle with, CPI doing what it's doing, with everything bubble doing what it's doing for helping receipts, when your deficits are still running 6-7% of GDP, which is way worse than it was at pretty much any other depth of a recession going back 40 years, with the exception of COVID. That's the problem, which is to say it's no longer a dial, it's a switch. That much leverage, it's just a switch. If you're in a recession, you're in a debt doom loop. If you're growing, you're inflating really rapidly, and or certainly above the 2% targets. And so that's the fundamental problem they have. They've got some other ones layered on top of that, but that's why when you look at the chart that I showed that said that on Twitter, which was the U.S. deficit against inverted unemployment, you've only seen a gap like that in that chart 2 other times in history: 1967 and 2019. And 1967, the next 12 years were pretty inflationary. The U.S. was, you had a gold market accident 6 months later. The U.S. was off the gold standard 3 years later. After that, you had the inflationary 70s. It was very, very inflationary. Some of that was driven by the oil crisis, but the tinder for the inflation of the 70s, and probably some of the kindling of as well, was really these twin deficits. Yep, Arthur Burns and the twin deficits, right? That chart shows that deficit rising while unemployment was tight. Why was that happening? Because of guns and butter. We were in Vietnam. We were doing great society. We're spending a bunch of money. A lot of it was borrowed. Employment was tight. And then boom, you have sort of the inflationary catch up. It happened again in 2019 in a little reverse order, right? We had the COVID, we had that gap blowout where deficits are rising sharply. Unemployment is very, very low. You have the COVID crisis, which, sends things down and then sends the printing into hyperdrive. And then we get the real inflationary back. So it's an order of operations question, but it's neither case there was really a muddle through. It's either sustained high inflation or, you can get a decline, but it's going to be a sharp decline. And then that's going to force them to come in and uber print again like they did in 2019, 2020 and 21.
Is there anything in the shadow banking system, Luke, that portends anything? Because I talked to some smart guys, and the shadow banking system in 2008 was half the size of the commercial banking system, and it's grown to 1.5 times the size of the commercial banking system. An example would be somebody like BlackRock would be in the shadow banking system, right? Or SoFi, or do any of these things in the shadow, as big as it is, could the problems come from places like Blackstone? I mean, they had problems with redemptions last year, and actually they took on a partner that basically saved Blackstone. It was almost like a rescue, a bailout for them. When the tide goes out and rates keep going, do you think that we could see some things as far as solvency in shadow banking as well as what we have on the books with regular banks? Aren't we due for a solvency part of this drama? Isn't that the third act, solvency?
It is. On the shadow banking, the short answer is I don't know.
Okay.
You've seen a lot of it there's a lot of asset-backed lending, consumer asset-backed lending, right? So we just had, for example, this subprime car lender, last week was trying to do a bond deal. Yesterday they just closed the doors. Not necessarily a huge deal in the grand systemic side of things. You've had a couple of very big players doing what we used to call on the sales desk jingle mail, right? On some major downtown office buildings. I think in LA and in New York. Where you mail the keys back to the bank, jingle mail. So there are some problems there. To me, I think when to get to the solvency part of this problem, it ties back to my initial point, which is I think we have to go back and remember we had a stock bubble and it burst, and we kicked it upstairs to the banking system by creating a housing bubble. It burst. We kicked it upstairs to avoid a problem, or for the bailout, up to the sovereign level. And to me, that's where really the solvency concerns lie, which is, when we hear and see these things about commercial real estate, if they keep taking rates up, what we're going to see is a nonlinear decline in tax receipts and a nonlinear rise in treasury issuance and in other sovereign issuance, where interest rates are going up and tax receipts are going down nonlinearly. And now you're going to have to issue more treasury issuance into, because deficits are rising countercyclically, into a weak asset demand environment. And that's where I said before, where you either get a debt doom loop, because now you're going to have a nasty recession where rates are rising, which is not something we've ever seen in America in any of our lives, but it's something that happens all the time in any developed
third world countries.
It's a third world country problem. Yeah, exactly.
You bring up sovereigns, and when everyone was kind of wrong-footed in the 10-year, when we were around 330 and everyone was saying, well, rates are going to turn, there were a lot of failed auctions in the 30-year. Rick Santelli would report and give it a D- on the 30-year. No one showing up. There's no bid, very little bid to cover on these 30-year auctions. So it's already showing up. We're having failed auctions on the 30-year paper right now, aren't we?
I would say the short answer is they've been the strength of the auction has been tied to the inversely correlated to the strength of the dollar, which is to say, as the dollar was getting stronger and stronger last fall, up to 113, 114, you were seeing 10-year auctions with 2 and 3 basis point tails. And exactly, I had a couple different senior hedge fund people reach out to me. Well, that was effectively a failed treasury auction, de facto. You saw the gilt market blow, the UK gilt market blow up.
Right.
You were seeing
JGBs.
The JGB market, you were seeing, the move index of volatility for the treasury market was at 160, last fall. The creator of that index said anything over 150 is a sign the Fed has lost control. So you were seeing exactly that. Now, as soon as the dollar went from 114 to 101, you had this string of really, really good auctions in January. Almost every auction stopped through. Very, very strong. So now the dollar has bounced from 101 to 104. Of the last 5 auctions, 4 have had a tail, decently sized. It's taking less of a strong dollar to start bringing this back. So there's this problem that international players cannot get involved with treasuries if the dollar's too strong, because the strong dollar is putting pressure on asset prices, solvency, economic growth globally. So US policymakers, global policymakers need to get the dollar down to prevent a treasury auction. I mean, a really bad outcome. But at the same time, getting the dollar down is feeding inflation, which is also going to create a bad treasury outcome. So you're getting to this situation where
there really is no way to resolve it without pain.
Like it's basically, how do you want the treasury market, how do you want treasury yields higher? What do you want the excuse to be? Higher inflation or crappy auctions? The issue ultimately, when you back it up, it's a supply demand issue, and nobody wants to talk about it. The US is issuing too much paper. Why are we issuing too much paper? Because we're 125% debt to GDP. A third of it rolls every year. And we're also running 7% deficits at the peak of the cycle. And our tax receipts are rolling over because our tax receipts are tied to asset prices on the margin. And oh, by the way, rising rates hurts asset prices.
Okay, I wanted to ask you, there's this expression, Luke, that anything in a bull market, anything that could go wrong doesn't. And in a bear market, anything that can go wrong does. Do you think that I know a lot of people are looking for some credit events this summer. Do you think that since we are in a bear market, at least in my view, we are, that we could end up with a self-inflicted wound? Because no one thinks that we won't go ahead and raise the debt ceiling. The narrative is it'll be theatrics, but at the end they'll do it. But if they drag it out, I'm reading that we run out of room in June for the extraordinary measures we're taking right now to run the government. And this tax season is very critical. Could we end up with a self-inflicted wound where even if we do go ahead and raise the debt ceiling, that we get downgraded again by Moody's, which wouldn't help either?
I don't know if we go to a full downgrade, but I do think this debt ceiling has a really good chance of being a lot more eventful than what we've seen. That I think people are. I agree with you that people are too complacent about this.
Yeah.
It's a different geopolitical environment. It's a different inflationary environment. The tax receipt situation. I mean, if I recall, that extraordinary measures was going to take us through September, like 3 months ago, 2 months ago, and it keeps coming forward.
Yeah, and an acrimonious political environment, which
acrimonious political environment. Exactly, yeah. Exactly. So, and you know, I think it's a wildly underappreciated dynamic. But when you have what we had last weekend, which is Blinken on the tape talking about sanctions on China and doing whatever it takes to Ukraine, Kirby, Sullivan, Yellen, like. I don't think
what's Yellen doing? What's Yellen? I saw someone sent me a picture of Yellen in Ukraine with Zelensky. What's she doing there?
I don't know, but I can tell you what they're doing that I don't think they realize they're doing, which is kicking the legs out from under the treasury market. Like, okay, war is inflationary. Like, and this to me is maybe the biggest perception out there is I hear, well, if there's a war, everyone's going to run into treasuries.
Yeah.
There's a war with Russia or China or even
the other casualty.
Oh my God. Like the last thing you want to own are bonds of any stripe. You want to own something. I mean, there would be nothing more inflationary than that.
Okay.
Yeah, it would be catastrophic. And I don't think they understand that. I think they think this is, I mean, even if you forget about a World War II type scenario of domestic government finance, you go to Vietnam. Like, find me a serious conflict with a serious partner where bonds bought you more real world goods at the end of it than at the beginning of it. And
great point.
You can't find it. You can't find it. So they've got to be very, very careful. And they're like bulls in a china shop. I don't think they understand. They're sitting in a house that's made out of sticks that have been soaked with gasoline, and they're just sitting there flicking matches over at Russia and China. It's not smart.
Yeah, and you bring up China, and you do what you call a blast from the past, where you'll go back and come up with a tweet that maybe was 10 years old. And I saw one from, I think, 2013, that China owns 5% of Ukraine. No one knows that, Luke. Do they?
No.
So why wouldn't they be allies with Russia? Maybe they could get a bigger percentage, but they really do own 5% of Ukraine.
That's that they at the time it said 5%. Then the Ukrainian government came out and said, well, it's not technically 5%. It's, they're just here. The big picture is for me is people like, well, the Chinese could sell our treasuries. I'm like, I agree with people say it doesn't matter because the government, U.S. government could buy them all right away. My bigger point is the Chinese have been way ahead of this. They've been selling dollars, swapping treasuries for farmland, copper mines, oil. And then we can get into a discussion of, hey, can their military hold what they have swapped their dollars for? That's a separate discussion. Again, very inflationary. But the discussion of what if China sells treasuries, that ship has sailed. The horses are gone. The barn doors have been closed behind them. Whatever metaphor you want to use.
They should be more worried about when the Fed sells treasuries.
That's the problem. Is the Fed's going to sell them? Treasury's going to sell more. Mom and pop. It's very one-sided. And the more the Fed raises rates, the more they have to sell. So and the more the balance sheet capacity to buy them shrinks domestically and globally.
So, we've been talking about this for a while. Do you have a feeling now, as you've watched all, your narratives progress, that we're getting closer and closer to when John Q. Public will notice that there's something wrong? Or when do you think that might become obvious? Some people are saying no landing now. Some people are saying, we're not going to have a recession. When do you think some of these things that we've talked about in the last 30 minutes are going to show up on people's radar screen and people be aware that we have problems here in America?
I think it's going to be a combination of sustained inflation and the passage of time, where it changes mindsets, right? So I'm in Cleveland, Ohio. Like, home prices in Cleveland, Ohio, they never participated in the upside. They still sort of fell a little. There's just been, and you're starting to see home prices here. Like, there was one near me, traded at a slight premium in 19, and then it sold for 60%, 60% more 3 years later in 2022. Those kind of things where people go, whoa, that's different. And then if it happens again, it's that kind of thing where suddenly the mindset changes to, okay, this is inflationary, this isn't going away. And it further indicts the credibility of the policymakers. Unfortunately for US policymakers, and I think it's a global phenomenon, but in the US, where I think there was this really ironclad faith in some of our institutions, I think they've suffered greatly, that credibility, over the last 2-3 years in particular, more broadly, the last 10 to 20, with some of the decisions we've made, how they were spun and how they played out. So I think it's a process. I don't think it necessarily is an event, but the challenge with that for policymakers is you don't know when, what the straw is that breaks a camel's back, right? When, hey, we're number one, and then we're running out of Afghanistan, and then we're, locking everything down, and then, hey, 1 shot to stop the spread, 2 shots to stop the spread, 3 shots to spread. Well, it's still spreading. Sorry, we shouldn't have locked you down in the first place. Math never worked. But all these things indict credibility, and I think if you keep an inflationary environment within that, and again, it ties back to my first point of, like, if they also crash things trying to fight inflation, that doesn't help their credibility either. Like I've said multiple times since last summer, where we began reading, Powell is saying he doesn't want to be the next Arthur Burns. He doesn't want to be the next. He's worried about his legacy. I appreciate he's worried about his legacy. My feeling is that if he truly understood the situation he was in, he would have resigned with clarity at the end of 2021, early 2022, with the insider trading scandal. Hey, failure to control. I'm taking a, because his legacy is going to get hit one way or another. He's either going to have high inflation, he's going to be Burns, or he's going to be Ben Strong. He's going to over tighten the world into a Great Depression. I mean, it's really, he's on knife's edge. It's a very difficult situation because of the leverage and the situation he has to try to manage through.
Okay, well, I think that he should have had your newsletter back then, and maybe would have had a different view. And Luke, best way for people to subscribe to your newsletter, The Forest from the Trees?
Absolutely. Yeah, you can check us out at our website, fftt-llc.com. A couple different options, both mass market and institutional options available through there.
Okay, so here you are, guys. Keep Luke in mind when you're thinking about, the future and what side of the market you want to be positioned on. And Luke, always appreciate you coming here and talking about things that aren't pleasant, but something that we all are going to have to face. Thank you, buddy.
Yeah, absolutely.
Luke.
Thanks for having me on again, Dale. It's great catching up.
All right, Luke Gromen, everybody. Follow him at Luke Gromen and check out his writings. Adios, Luke. Thank you very much.
Take care. Thank you, Dale. Have a great day.
All right, and that's a wrap, everyone. You could join the team in about 15 minutes on the Morning Edge. Hope you enjoyed Luke, and we'll see everyone tomorrow. Good hunting today. Looks like they're trying to turn the metals here. Adios. You're welcome, guys.